Good morning or afternoon, everyone. My name is Brandon Oliver. I am with Arcwood Financial. We are most likely your employer's advisor and consultants for your group retirement plan. And as part of that, what we do for all of our participants is provide 401k advice. Many of you have probably called me before, 401k education, and also education around financial wellness. Today, I'm recording a quick video that will be in our Savings and Budgeting Basics series. And specifically today, we will be talking a little bit about paying off debt. I think a really good place to start with paying off debt is just giving an example. And what I'm going to do here is just talk about the opportunity cost of having to pay interest or putting money somewhere else versus putting it to investment, because it's kind of what I understand. I'm more of an investments guy. So let's use an example here. I have somebody with a credit card balance of $2,500. So for whatever reason, they had a credit card, it started adding up and they started carrying a balance. In this example, they have an 18% interest rate. That's probably more common with one of your benefit cards, right? The ones that you get really good travel bonuses on and things like that. The ones you're usually not supposed to carry a balance on and pay off every month. But for some reason, things get out of hand and now you're carrying a balance with a high interest rate. In this example, that would make a $50 minimum payment. And to pay that $2,500 off with that 18% interest, it would actually take us 94 months to pay that off at the minimum payment, which is what a lot of people do. And over that period of time, we would have accrued $2,200, $2,156 in interest paid. Now, all I'm going to do here is just kind of highlight one factor about why carrying debt is bad, is our opportunity cost. If instead of putting a $2,500 payment onto a credit card, instead of maybe saving up and paying for that out of cash flow, and also not having that pay that interest to a bank instead, just going straight out the door. Let's say we added those two things together, right? We took our $2,500 and our $2,200 and had $4,700, and we put that into our investment instead. So I'm going to use time value of money and show the opportunity cost here. So if you have a $4,700 that you put into, let's say your company-sponsored 401k, right? On average, you're getting an 8% rate of return if you probably have a balanced investment, or if you go back to the beginning of the market when we track it, it's usually around a 10% compound rate. Let's be a little bit more conservative and say it's 8%. If we have 25 years of compounding, right, I don't know, that could be if you're 25 years from retirement, or maybe you're a year from retirement, but it's coming due at the end, right? 25 compounding years to let that rate of return go. Your ending balance would be $25,000. And then the interest you would have paid to yourself versus having to pay to somebody else would have been $20,000. So this is it. $2,500 credit card payment. The opportunity loss there is $25,000 to your future self, right? There's a 10x disparity there in going into debt versus savings. So that's where I like to start. But really, that's not what today is about, right? It's not about guilting people into why they shouldn't use credit cards or why they shouldn't use unsecured debts versus why they should save. It's really hopefully to inform all of you or educate all of you on some of the main techniques to actually pay off this debt. All right, so paying off credit cards. Common knowledge is when you have multiple credit cards, it's more effective to focus on paying off one credit card at a time versus spreading out your payments. Obviously, you have to continue to make minimum payments on all of your credit cards so you avoid late fees or any penalties and you stay in good standing. But the next step is it's tough to figure out for some people, well, where should you start? So there's two really big schools of thought on this. Option one is starting with whatever credit card balance or whatever credit card you have that has the highest rate of interest, the highest interest they're charging you, and then working your way down. So in my example, XYZ person has one credit card with a 21% rate of interest on it, charging 20. They also have another credit card that has an 18% interest rate and a 10,000 balance, and the last one has a 15% interest rate. In this example, they are doing the highest interest rate first and working all the way back down. Now, from a technical aspect, and we'll go into this a little bit more, that makes the most sense in total dollars, right? But there's another option, which is called the debt snowball. And what this does is goes the other way around. Instead of focusing on highest interest rate first and working their way down to lowest interest rate, instead they focus on lowest in a video. It's kind of long, but it really explains how these two techniques work and why you might gravitate to one over the other. Let me pull those up. All right, here we go.
Hey everyone, Daniel here from Next Level Life, and today I realized that I've been ignoring another big area of personal finance: debt. And I don't know how I can be a self-respecting personal financial YouTuber if I don't at least touch on that subject. So today I'm going to be talking about debt. More specifically, I'm going to be talking about two very popular ways that people try to pay off their debt. And that is the debt snowball strategy and the debt avalanche strategy. I'm going to be talking about how both strategies work, as well as the benefits and downsides to each. And then I'm going to wrap it all up by comparing the two in a very similar example to see which one actually works better. First, I'm going to be talking about the debt snowball. How does it work? Well, the debt snowball, as made famous by Dave Ramsey, tells you that you should be paying off the debt with the lowest balance first. Regardless of what the interest rates on all your debts are, you order them from smallest balance to largest balance and you pay them off in that order, making minimum payments on all of them except for the smallest one and attacking that smallest one with a vengeance. Throwing everything you've got at it, selling so many things that the kids think they're next. And you do that until you've paid off that smallest debt. And once you've paid off that smallest debt, you take the minimum payment that you were using towards that smallest debt, as well as all the extra money you were throwing at it, and you move it to the new smallest debt. And when I get to the example, I'll put some numbers to it so it makes a little more sense. But that's basically the concept. The benefits, of course, have been found to be very psychological in nature. Because you're paying off the smallest balance first, you see progress very quickly, at least in comparison to other debt payment strategies. And as each month goes by and you pay off more and more of your debts, you get less and less bills coming into the household, and that motivates you even more to continue paying off debt. The momentum continues to build up until you're finally debt-free. That's the theory anyway. But there has actually been some evidence to back it up. In fact, the Harvard Business Review did do a study recently and found that people using the debt snowball did tend to actually finish paying off their overall debt more often than people who use other strategies. But that's not to say that there aren't downsides to using this strategy as well. The main one that people throw at the debt snowball is that it's not the most mathematically efficient way to pay off debt. And that is absolutely true. Probably the most mathematically efficient way to pay off debt is by using the debt avalanche. So let's get into that. The debt avalanche is, as one of my finance professors back in college would often say, similar to the debt snowball, only different. The debt avalanche says that instead of ordering your debts from smallest balance to largest balance, you should instead order them from the highest interest rate to the lowest interest rate, and pay them off in that order. The benefits, of course, is that you do get out of debt faster than, say, with the debt snowball strategy, because you're paying the higher interest rate debts off first, which means you'll end up paying less interest overall in the long run. And with more of your money going to principal, the debts do get paid off faster. The downsides to the debt avalanche, in my opinion, are that it doesn't really take emotions into account. And as I said just a moment ago, studies like the Harvard Business Review have found that the debt snowball does tend to lead to people paying off more of their overall debt in the long run. So let's go through a quick example here to show how these two strategies work. Let's take John and Jane. John is going to use the debt snowball to pay off his debts. Jane is going to use the debt avalanche. For the sake of simplicity, I'm going to assume that they both make the same amount of income, and they both have the same amount of taxes, the same amount of expenses, all that jazz, same amount of debts. And again, just to keep things simple, I'm going to leave it to 3 debts. I'm going to have them have a $25,000 credit card balance, $20,000 in student loans, and a $10,000 car loan. The interest rates for both John and Jane are going to be 15% on the credit card, 4.45% on the student loans, and 4.21% on the car loan. I chose these numbers mainly because they seem to be right around average. So the minimum monthly payments on the 3 debts will be $750 a month to the credit card, $200 a month to the student loan and $185 to the car loan. The income for both John and Jane is going to be $59,000. They're both going to have expenses of $24,000, and as for taxes, they're going to take the $24,000 standard deduction and pay about $8,750 a year to the government, which means that both, after taxes and expenses, are going to start with about $1,052 left over at the end of every month after making their minimum payments on their debts. And I did the numbers this way because it leaves the credit card balance as the biggest balance and the highest interest rate. So we're going to see as big a difference as we can between the debt snowball and debt avalanche. So we'll start with John. As I said, John will be using the debt snowball to pay off his debts. Since he's using the debt snowball, he's going to start by trying to throw everything he's got at the car loan, which is $10,000 in his case. He'll make the $185 minimum payment on the car loan, as well as the $200 and $750 payments on the student loans and credit cards, and throw all of that $1,052 that he has left over at the end of the month onto the car loan. And in doing this, he will have the car loan paid off in full in 9 months. Now, his snowball payment will increase because he's no longer having to pay $185 a month on a car loan, which means his new snowball payment is $1,237 a month, now that he's going to be starting in month 10 paying off the student loans, since that's the next lowest balance. And again, for the sake of simplicity, I'm just going to assume that the balance is still $20,000 for the student loan. So starting from month 10 of his debt payment strategy, he will start knocking out that student loan as fast as he can. And running the numbers, we find that at the end of the 23rd month of his overall debt payment plan, he has knocked out the student loans completely. Now, all he has left is that credit card bill, which again, for the sake of simplicity, I'm going to assume is still $25,000. John's snowball payment again increases because he's no longer having to put $200 a month to make the minimum payments on his student loans, which means his snowball payment goes from $1,237 a month to $1,437 a month. He makes the minimum payment on his credit card and throws all of that snowball payment at it as well and pays off the credit card in full at the end of the 35th month. So in about 3 years, John managed to pay off a $10,000 car loan, a $20,000 student loan, and a $25,000 credit card bill. But how does that compare to Jane? Jane is using the debt avalanche, as I said. She has the same debts, same income, same expenses. Except she's paying off the debts in a different order. Using the debt avalanche, she pays off the debt with the highest interest rate first, regardless of balance, meaning that she's going to throw everything at the credit card bill right from the start. And what we see is Jane takes quite a long time to get that credit card bill paid off, which is understandable. It has a very high interest rate and it was the largest debt to begin with. But whereas John managed to pay off his first debt and see some progress at the end of 9 months, Jane doesn't see any progress until the end of the 16th month, almost twice as long as John. However, on the bright side, she does have the credit card bill paid off in full, so the biggest hurdle has been done. And her snowball payment, which again started at $1,052, just like John's, has now increased to over $1,800 because she no longer has to make the $750 credit card bill minimum payment. And she can throw all of that at her student loan, which is the next highest interest rate at 4.45%. She'll do that starting in month 17 of her debt repayment plan, and she'll have it paid off in full by the end of the 26th month. Now all she has left is the car loan. And she can again, just like John, take that $200 that she no longer has to pay for her student loans and lump it into her avalanche payment, which is now over $2,000 a month. So as you can imagine, she pays off that $10,000 loan pretty darn quickly. In fact, by the end of the 30th month, she is debt-free. So she managed to pay off the same amount of debt as John in 5 fewer months. And the big reason for that, of course, is the difference in interest payments that these two made. John, using the debt snowball, kind of left his credit card bill until the end. It was the highest balance, it was the highest interest rate, he accumulated a lot of interest payments. In fact, he paid over $10,000 in interest over those 35 months. Meanwhile, Jane, in her 30 months of debt repayment, only paid about $4,700 in interest because she knocked out that credit card right away. So looking at the two and comparing them, there's not really any question as to which one's going to get you out of debt faster. The debt avalanche will get you out of debt faster, if you stick to it. The big reason why the debt snowball is so popular, though, is because it's very hard to stick to the debt avalanche when you're not really seeing any tangible progress for so long. Remember, Jane did not have her first debt paid off until 16 months into her debt repayment strategy. That is a long time to not see much progress, even if you know it's going to a good cause. So which debt repayment strategy is right for you really comes down to just knowing yourself and how you would handle these sort of situations. Which is going to motivate you more? Knowing that you're going to get out of debt faster, even when you're not seeing any tangible progress right away? Or seeing the tangible progress, seeing less and less bills coming in the mail every month, even if it means you're going to pay a little bit more interest in the long run? So what did you think about these two debt payoff strategies? Have you heard of them? Did you learn something? Do you have another debt payoff strategy that you're using? Let me know in the comment section below, and don't forget to like, share, and subscribe. And I've got a lot more of these finance videos coming. I will be uploading every single Friday at Debt.
Great. Yeah, I mean, there's versions of that that are probably a little bit more exciting. I know the Smart Dollar and Dave Ramsey people spend a lot of energy on exciting participants and people who participate in their baby steps and their programs about using the debt snowball. I like this one because obviously I'm a numbers guy, I'm a nerd, but I think it really does explain the two strategies really well. And just like investing and everything else we talk about, it comes down to what fits with your personality. Also, like everything else with financial wellness, personal finance, and even savings, I hit home on this a lot, and I apologize, but I repeat myself. You have to do it in conjunction with your partner, right? If you have a spouse at home, or you're in a relationship, when you're going after debt and paying down debt or saving, really, any of those things, it needs to be a team effort. If one person is focused on paying down debt and the other really isn't on board, or trying to get to a dignified retirement early, or just have enough to have a great retirement, you have to be on the same page. So I recommend reviewing this together. But I do think it's a really good exercise. I really like the debt snowball. I like that whole idea of, winning, maybe it's a battle, it's you versus debt, and then being able to knock a little credit card off and just say, good riddance to you, to one of them, and be like, let's go after the next one. I like that. But again, I know my engineers in the room, my other numbers geeks, you might like the avalanche, but again, you got to stick with it, because that is a slightly harder road, even if the math works out better. I know I don't have a lot of time. I chose a pretty long video, and I'm probably losing your interest. I think we do need to bring it home really quick. Obviously, we just saw that person increase their discretionary savings up to $3,000 a month from $1,000. Let's just do compound interest again, right? If all of a sudden you have an extra $3,000 a month that you can put towards savings, if we have the same 25 years at that 8% rate of return, I mean, I'm just talking about 1 year here of 36,000, but that could be as high as, almost $200,000 in 25 years. But, you don't have to put it all towards retirement, right? Hopefully you're saving for retirement and trying to bring down debt at the same time. But once you free up cash flow, all of a sudden you have all this extra money to save. And it doesn't just have to be for retirement, right? Now you can get going on that vacation home, or maybe helping with college, or, if it is your goal, retiring earlier. So instead of just being able to put 5% in the 401k or 6% in the 401k, or hopefully you're at 10%, which is the rule of thumb, now you have an extra, whatever you're paying towards debt, every month to add to that, you are going to hit your goals so much faster. I'm going to talk about mortgages a little bit, because this is the largest debt most of us have. And obviously real estate is an asset as well, but paying off your mortgage will help most of us get to retirement sooner, or have more discretionary money to put towards savings. What we're focusing on here is different amortization schedules you can use to pay off your mortgage faster. Number one thing, before you start any amortization schedule or making any kind of extra payments, speak with your mortgage company first to make sure what kind of extra payments they'll accept and in what format they'll want those in. I know some of the bigger banks have an option right on your portal when you go in to make a payment to show, hey, I want to start making an extra X number of dollars per month, only going to principal. Other ones, it might be a paper process, or some older loans, they might not even allow some of these strategies. All of this is available on the internet. You do not need to go and enroll yourself in some mortgage accelerator class over a couple of weeks and pay anyone. All you need to do is hopefully just watch this video and then talk to your bank and then commit to making some kind of additional payment towards your mortgage. So I'm going to go over some of the basics. Paying off your mortgage early. Here's one, and we'll just kind of go down them. The bi-weekly mortgage payments. The concept here is pretty simple. You make half of your mortgage payment every 2 weeks versus just doing it every month. The result would, because you're paying off some of your payments a little early, the result is results in 26 half payments, which will equal 13 full monthly payments each year, because you're kind of getting an extra one there. The extra payment can knock up to 8 years off a normal 30-year mortgage, depending on the interest rate. Again, check with your mortgage or whoever's holding your debt. Strategy 2 is making an extra house payment each quarter. You'll pay off your mortgage 11 years earlier versus 8 years earlier. And based upon an interest rate, this can be a lot of savings, right? A lot of people, once they're to the point where they have enough cash flow to maybe pay down the mortgage early, will look into 15-year mortgages. You don't have to do that. You could just instead look into what a 15-year-old payment would look like, and then just start making double payments, essentially. Act like you have a 15-year mortgage. Instead of making one mortgage payment every month, now you're making two, right? This probably gives you a little bit more flexibility if you're worried about cash flow in the future than actually refinancing into a 15-year. Option 4, and there's some benefits here, is actually refinancing into a 15-year fixed rate mortgage. And for that, hopefully getting a lower interest rate. Definitely make sure you have the cash flow that you can continue to do that, because if you can't make those larger payments down the road, you are going to have issues. That's it for me today. I know it's a little bit longer, but there was a lot of math involved with that debt avalanche, that debt snowball. I'm always available to anyone who wants to discuss these topics. Mainly, my main hat is investing, so hopefully take all this with a grain of salt, do a little research on your own. But I really think the more all of us can focus on paying money to ourselves versus someone else is going to get us to our goals much, much quicker. Thanks for your time. I appreciate working with all of you, and we'll talk soon.